Hello, everyone. Welcome back to another important update on macro conditions. So we took a couple of weeks break from talking about macro and kind of dived more into fundamental analysis, including the discussion from 2 weeks ago about share buybacks. So if you haven't had a chance to look at that, I really encourage you to go back to our YouTube channel at Zacks Pro and look for that video. But this is a continuation of a long series of videos dating back to, basically October of 2022. And, kind of walking through the same exact framework of thinking and charts and data tables and so on, but with several updates to each of those and an update to commentary. So let's get started. And if you've been following me here, I've been, basically talking about this for the past year now, again, dating back to September or October of 2022. I've been, consistently bearish on the U.S. equity markets because I continue to believe that the leading indicators of both GDP as well as the leading indicators of earnings, S&P 500 earnings continue to point to recession, both from a GDP recession point of view as well as a general economic recession as defined by the NBER, which is the committee that decides if and when recessions have started and ended. So I continue to believe that we will see an economic recession as well as an earnings recession, based on the direction and the trend of leading indicators that I believe are leading indicators for both of those items. So let's get started with taking a look at each and every one of them. And here I've started out with a summary as to why I believe that is the case and remains the case through today. And today is the 2nd of November, 2023. To begin with, U.S. manufacturing remains in recession. This is the aggregate, collection of indicators, namely the Chicago PMI, ISM Manufacturing PMI, the Philly Fed Index, the Empire State Index, and others as well, such as the Dallas Fed Index. All of these regional and national manufacturing gauges have been and remained in contraction for the past 11 to 13 plus months consecutively. And backlog remains in deep contraction as ISM orders are at new lows. This, I believe, implies weak demand and that production will, in fact, begin to slow to catch down to that very weak demand. And this will inevitably trigger layoffs in the manufacturing sector. Again, this also implies, and this is more important for us as investors, and you'll see a couple of charts that shows exactly why, but I believe that this will put pressure on S&P 500 revenue and earnings per share through 2024, because the longer these gauges remain in contraction, the higher the probability that it begins to weigh on growth expectations for 2024. So again, we'll see the relationship between Chicago PMI, ISM Manufacturing, to corporate earnings, which is what matters the most for us as investors. So the first point is that manufacturing remains in recession and has been so for a very long time. And the longer that remains the case, the duration of contraction, if it's for a month or two, it's not a big deal. But if it's now been a year plus, this is now cycled out. We're now basically fully cycled out of the inflationary boom of 2020 to 2022. So it's been a full year since we've cycled out of that. And so now that those manufacturing gauges remain in contraction even after an entire year, I believe this is now looking like we're below trend. Before, if you're, in a boom and you experience a contraction, that's simply, a case of mean reversion. Because when you overshoot to the upside, as the case was, and, a vast majority of economic data points were well above trend. And so if you get a couple of months of contraction, That's not a big deal because that's just mean reversion. But if we've been in a 12 to 13, 14, 15 month long contraction, this is not just mean reversion now. This is an actual decline below trend growth, in my view. So the longer this remains the case, the bigger the case is that this is now recessionary rather than just simply mean reversion. Especially when you take it in conjunction with the next several points here. And so point number 2, cyclical employment is in its 4th consecutive month of year-over-year declines. We'll take a look at exactly what that means, but despite the fact that the headline non-farm payrolls job growth has been very impressive, jobs coming from cyclical industries are contributing to a decreasing percentage of total jobs created. So if you remove government, education, and healthcare jobs, which are non-cyclical by nature, because these do not, wax and wane with the business cycle. So they don't add a lot of analytical value. So if you remove those 3 sectors and look at the growth in jobs of the remaining sectors, that's now been in contraction year over year for 4 consecutive months. This implies that there is a tightening labor market building beneath the surface. It hasn't yet shown itself in the headline number because it can be obfuscated from these 3 non-cyclical sectors. But inevitably, the headline number will follow the cyclical number. It always has in every recession. It always has followed up during bull markets as well. So cyclical job growth is the name of the game. That's the leading indicator for the headline number. So that means that there's a tightening labor market that's building beneath the surface. And the longer this remains in contraction, the duration matters. So it's been 4 months now. It could take 5 or 6 months before the headline NFP starts to crack. Maybe it takes 7 or 8 months. The point is that it's building. And then an ancillary data point is that temporary help services. This is actually a leading indicator of recession. That's been in contraction now for 10 consecutive months. So although job losses, meaning initial claims, continuing claims, the unemployment rate, as well as permanent job losses that's reported each and every month as a part of the NFP report, although all of those metrics have been historically low, they are steadily building now. And as of today, we just got the weekly update on continuing claims, and that's actually now back to 2023 highs. And historically speaking, if any of these numbers, continuing claims, initial claims, or permanent job losses, whenever one of these 3 or any of these 3 measures of job losses takes out a medium-term moving average. You can use a 1-year, you can use a 2-year moving average. The crossover versus its moving average has historically been the leading indicator for an oncoming rout in the job market. And that has not happened yet, but it's starting to look like it will. Because now, initial claims are at historic lows, continuing claims have been at lows, and now they're starting to move up. And a leading indicator for initial claims are WARN notices. They're called WARN notices. And that actually has spiked significantly in recent months. So I believe that we will now start to see initial claims starting to rise. And as of today, we just started to see that. It's still very early, but I believe that in the coming months now, we're about to see the start of rising joblessness. And you definitely don't want to see that happen, but that's inevitably what I think will be happening given the pretext and the context of everything else that we see here throughout all of these points. Another very famous recession indicator, the inverted yield curve, the 10s minus 2s, that's been inverted for quite a while now, for more than a year, almost a year and a half. And now it's been re-steepening. And remember, it's the re-steepening that usually coincides with the start of recession. It's not just the inversion that coincides with the start of recession. That's usually the eye of the storm. It's when it goes from a prior inversion to rapid re-steepening, that's usually around the time that recession commences. And that's exactly what we have seen now, especially in the last 2 months, starting in September and building into October. We've seen a rapid re-steepening of the yield curve driven by rising long bond yields, which, by the way, has not happened in our entire adult lives. Especially not in my life. I'm a millennial, so I really haven't seen the last time this happened. And the last time this did happen was in the late 70s, where the long bond rose faster than, the long bond started to rise faster than the short-term Treasury bill rate, such as the 2-year. So it's been a long time since we've seen this happen, where re-steepening happens with the 10-year yield increasing faster than the 2-year yield. So this is all new, uncharted territory that we haven't seen in quite a while. So I don't think this is a very kind time for equity markets right now. Now, real retail sales have picked up. I've been saying that that's actually been negative. It actually turned around and it's now back to positive territory, albeit very, very slightly. It's been the first positive reading after 7 consecutive months of year-over-year declines. So the point there is that growth remains very, very tepid. So if you look at retail sales, but back out the effect of inflation, there's almost no growth in retail sales. The Conference Board of Leading Economic Indicators, that's been in deep contraction now. And this is actually a typo. It should read 18 consecutive months, not 16. So we've now been in contraction based on the index of leading indicators for a year and a half. Banks remain under pressure. We've seen new lows in EPS estimate revisions. And here's the kicker. Unlike past market environments, the Fed, and this is very key to understand, the Fed is not supportive of stocks or bonds right now. And it won't be until we see a sizable economic decline. So right now, the Fed is not a friend to the stock market or the bond market. And I believe Jay Powell has been very clear about that for more than a year and a half now, that they do not mind seeing or delivering some hit to the economy if it means they can get the inflation genie back into the bottle. And Jay Powell, I think, has been very consistent at trying to convey this message to the markets. And the markets just simply haven't really truly listened yet. And I think they're just now starting to internalize the fact that the Fed is not going to suddenly cut rates at the slightest sign of market distress. The Fed is going to see this through and to make sure that inflation comes back down to their long-term objective of 2%. A lot of people have been calling for a revision of that to 3%. That's not going to happen. I think the Fed is, very, very adamant that they are keeping the target at 2%, and they're willing to hit the economy, even though Jay Powell doesn't say it in those exact words. I think that they're willing to hit the job market and get the unemployment rate up just a little bit in order to get inflation back under control. So again, here's the reasons why I think that the economy is under pressure. The 10-year real yields are well above 2%. This is the highest level basically in 20 years. You can go all the way back to the mid-2000s, the last time we saw real yields this high. Again, this is the cost of capital. And the cost of capital is the most powerful force in financial markets worldwide. This is the benchmark for all economic decision making. So as the benchmark rate increases, that's the hurdle rate upon which all investment decisions in the business world are compared to. As that hurdle rate rises, it suddenly makes investment decisions at the margin less attractive. Because remember, as businesses invest in themselves in the future, they have to, do a thorough analysis of the IRR that each of these CapEx projects have, right? So when companies have their capital budgeting, they look at, what's the rate of return we're going to earn on, say, every $1 billion of CapEx that we invest? And a year ago, that number, even if it was 3%, compared to a real yield of 0, a 3% return on capital was considered to be attractive, because where else can you park money, right? If the alternative is 0, then a 3% return on your investment, 3% return on invested capital would be attractive. Now, with real yields at 2%, a 3% ROIC is not so attractive, anymore, especially given the risk. So companies will elect to, either invest in treasuries or to return capital to shareholders, because they don't see investment opportunities that return that generate returns that are significantly better than the 10-year real treasury yield. So at the margin, as the cost of capital rises on a real basis, right, it makes the marginal investment dollar less attractive, unless if you can get a commensurate increase in the ROIC. So inevitably what this means is CapEx will come down. At the margin, this will hit investment decision making. So again, the question now is that, what's the primary driver of higher yields? And this is just one theory. I could be wrong about this, but this is just my theory, is that we will see a huge issuance of U.S. treasuries. So some 30% of all U.S. government debt outstanding is set to mature in the next 6 to 12 months. And the federal government is in a deep fiscal deficit, almost $2 trillion. It's about 8% of GDP, which is the deepest deficit to GDP ratio we've seen outside of recessions. So if it's this deep, despite the fact that we haven't even seen the start of a true recession just yet, imagine where that number is going to be in recession when tax revenue gets hit. So this is creating potentially a debt spiral of deeper deficits due to borrowing at increasing interest rates. And the Fed is remaining steadfast at keeping rates higher for longer. They're really not forecasting many cuts for next year. They may be done with this interest rate hike cycle, which I believe is the right call to make. But they may not cut as much as people are thinking that they might cut. They might have one cut next year, maybe even 0 next year. We'll see. But that's substantially down from expectations just about 3 to 5 months ago, where everybody was expecting multiple cuts next year. So this means that we now have true price discovery in the bond market amid escalating government deficits and no support from the Fed. So this could be the reason why we're seeing a sharp rise in the 10-year yield, as the market finally internalizes the fact that we have huge, treasury issuance, massive deficits, and no support from the Fed as a typical buyer in past environments. Analysts are still expecting 12% earnings growth, but I believe the leading indicators of earnings suggest that this is vastly overstated. So I think that earnings estimates will be marked down, as the sharp rise in the cost of capital I just said will inevitably lead to rising delinquencies, defaults, bankruptcies, and ultimately job cuts. And here you can see why. So here's one example of how manufacturing gauges, Chicago PMI and ISM Manufacturing, correlate to S&P earnings growth year over year. So here in orange, you can see the earnings growth expectations for the S&P looking forward 1 year versus the level of the Chicago PMI and the ISM Manufacturing Index. So you can see a very strong correlation between both of those manufacturing gauges and S&P forward earnings growth. And here is an interesting development here, that throughout history, we've seen these two rise and fall together. But look what's happening right now. You can actually see that both of these manufacturing gauges are turning back down, and yet you're seeing rising earnings estimates. I believe that that's going to come down. That's going to correct itself. Again, with a sharply rising cost of capital and manufacturing already in recession, this is going to put extraordinary pressure on S&P revenue and earnings in the coming months. So I believe you're going to start to see these estimates come down. Ultimately, this is not a driver. Manufacturing is the driver. This is an estimate coming in from analysts, and that will change as we see a couple more months, maybe even just one more month of weak Chicago PMI or weak ISM Manufacturing Index. But now that we just got this yesterday, in fact, maybe that will start to trigger a wave of earnings cuts. We'll see about that. Again, a lot of the bulls say that, this is all fine, but GDP looks very, very strong. We just saw Q3 GDP clock in at 4.8%. That was terrific. But check this out, though. This is actually an alternative measure of GDP by the Philly Fed. The Philly Fed publishes what's called the GDP Plus, which does a number of very important adjustments to GDP. Long story short, if you're familiar with the GDP report, they publish GDP along with the subcomponents of GDP, along with GDI, right? GDI is the other half of the equation. GDP measures production, GDI measures income. Theoretically, they're supposed to be the same, but sometimes there is a disconnect between the two. So GDP Plus seeks to make all the right adjustments to GDP to make it more analytically meaningful. And if you do that, check out how different the GDP Plus reading is versus GDP. So here you can see quite a wide dispersion between what we saw in the headline number and what GDP Plus is telling us. A difference of 150 basis points there. That's pretty substantial. So although 3.3% is still pretty good, it's nowhere close to what we saw at the headline number at 4.8%. And we're going to get the GDI update in a month from now. So GDI, typically comes out later from the GDP report. That's one of the reasons why it doesn't get as much attention. But I believe that you're going to see that number not confirm the GDP number by nearly as much. So we will see what happens. But again, the Philly Fed is actually telling you that GDP is not as strong as it appears at the headline. Another gauge of manufacturing, the Philadelphia Fed Manufacturing Index, again, that's at recession levels. A single reading below 25 has correctly forecasted each of the last 8 recessions, and we just got there earlier this year. ISM Manufacturing, you can see the correlation between ISM and S&P earnings growth. And again, you can see how amazing this correlation is between the two. And look at the divergence that we just started to see here. As of the latest update yesterday that came out on November 1st, ISM ticked down once again. So that's about 12 consecutive months of decline, being below 50 reading. So I believe that this bearish divergence is not going to continue for too long. If we see one more month, I believe, of the ISM Manufacturing PMI, you're going to start to see this number come down. This divergence cannot persist, in my view. One of these two are going to have to give. Either ISM Manufacturing needs to have a strong rebound, or you're going to see cuts to earnings expectations. Again, and one of the reasons why why the PMIs are weak is because it's being led down by ISM Manufacturing new orders. That's one of the subcomponents of the manufacturing PMI. This is a proxy for industrial demand that continues to remain sluggish, firmly at recessionary levels. Remember, we don't get these levels outside of recessions. You can see that clearly here. And it's been this way for quite a while. So again, it's not just a 1 or 2 month period. Duration matters. And we've now been in this contraction for 12 months. Again, you can't continue to ignore the leading indicators of earnings. Because the longer you do that, the more it's going to weigh on earnings expectations. And that's why I think it's going to be cut, in the coming weeks and months. Factory work week hours are being cut. Again, another indicator of recession. So recessions are always a slow buildup of many things. But if we see a rapidly re-steepening yield curve, this might be a sign of deterioration, which can lead to someone big being caught offsides. So again, we are going from a deep inversion to now a re-steepening. So this has been a big development since September and into October, where we saw a sharp rise in the 10-year yield. That's leading to a rapid re-steepening of the yield curve. Remember, if you look at the past recessions, the inversion by itself is not an indication of an imminent recession, but rather the re-steepening from a prior inversion is the more important piece of it, because that tells you the imminence of what might be happening. So the inversion happens, 1 to even 2 to 2.5 years prior to the start of recession. But the re-steepening happens when something is about to go down, as you can see in these past, 3 recessions here. And I believe this time is no different. You saw the inversion, well ahead of the recession in 2007, but then the re-steepening started to happen in mid 2007, early 2007 or so. And that's when something started to happen. The market also topped out in December of 2007. Same thing goes back here, where the market topped out in 2000. And that's, again, around the time where we started to see re-steepening. And we're starting to see something similar to that now. So if this gets back up above zero, I think that we might be commencing what I've been afraid of since, September of 2022, and what I've been talking about here since then. So I would keep a very close watch on this number. The Conference Board leading economic index, that's been in decline now for 18 consecutive months. So this is again firmly at recessionary levels. It's being led by weakening credit growth and manufacturing new orders, as I just mentioned. Again, duration matters. If you're in contraction for a month or two, that's not as meaningful, but this is now a year and a half. So we have cycled out of the above trend inflationary boom of 2020 to 2022. That's done and dusted. So now we're tracking below trend on the underlying items on all these indexes, in my view. And again, history shows that forced inversions break things. So again, I think the Fed got a little bit over enthusiastic with these rate hikes. Here you can see a chart of the Fed funds rate minus the 2-year yield. And again, as this number goes into inversion, something typically breaks. So this was the deepest inversion since 2007, where the Fed, hiked well above what the 2-year yield was asking for. Remember, the 2-year yield is more of a market rate. It's still a short-term interest rate, but because it's just slightly outside of that, short-term duration, this has more of a market feel to it while still remaining relatively short-term. So the 2-year yield is a very, very important metric because, again, it's still short-term, but with enough market forces acting behind it to tell you what the marketplace, what the bond market thinks the appropriate short-term rate should be. So when the Fed takes it, above what, the marketplace thinks short-term rate should be, by a very large extent, that typically leads to something breaking down in the economy. So we saw that happen in 2007, in 2000, briefly, in 1998, and here in 1989 as well. So that same thing happened just recently here, and now we're starting to see that re-steepen. Again, it's the re-steepening that typically coincides with the unwinding. And we don't know exactly where that unwinding will hit. We just know that it's looking like history is repeating itself from these past recessions here. I believe that banks could be one of the epicenters of that. It could be regional banks, it could be somebody else, but banks continue to face tremendous difficulty. We see them putting out multiple fires simultaneously. They have large unrealized losses on held-to-maturity securities in their Treasury portfolios. They are seeing increasing depositor withdrawals. They're seeing declining commercial real estate prices, which especially regional banks have huge exposure to. They're posting rising loan loss provisions as a result of all of that. The net effect of all of that is tightening credit availability. So again, you can see here that once again, depositors are withdrawing their money from banks. This is looking at deposits across all commercial banks here. That number has been stabilized since that Silicon Valley, bankruptcy, but you can see that it started to slip here as of September and October. So we'll see if that takes out the lows there. But if it does, that's going to put a lot of pressure on banks to be able to come up with the liquidity to satisfy all of that investor redemption, all of those depositor redemptions. Loan loss provisions are rising. Again, they are at elevated levels. You can see that here. It's at levels that we're seeing, entering the 2008 crisis. I don't think it's going to get as crazy as it did back then. It won't even get as crazy as it did, during the COVID, pandemic. But it looks like it's starting to rise again, consistent with recessions. Again, the net result is tightening credit availability. So here you can see a survey. This is published by the Fed. And this is showing that, banks on the aggregate are tightening credit standards at the highest rate, which is, again, consistent with recessionary periods, 2000, 2008, 2020, and now here again today in 2023, entering 2024. Again, deep cuts. This is leading to analysts cutting deeply into regional bank earnings forecasts. These estimates have been slashed and shows really no signs of stopping. So again, regional banks are dealing with they're dealing with multiple fires simultaneously. I believe that the banking crisis is just not yet over. Inflation is bouncing back a little bit here, but core continues to come down. I believe that's going to continue. I think core inflation will continue to drop. That's consistent with backlog remaining in deep contraction. This is a function of a typical deflationary recession. So I believe that now that backlog is, in contraction now for more than 12 months, production is significantly outpacing demand. And that's what happens when backlog comes down. So as long as this continues to be the case, I believe that core CPI will continue to come down. And again, that's consistent with my recessionary call here. The Fed, again, is dedicated to removing liquidity. We've never seen this happen in history, where M2 is negative year over year for the first time in history. That's just simply mean reversion. So I believe the Fed wants to bring that back to trend. So it really needs to right size that, substantially more here. Again, as the Fed removes liquidity, as banks tighten credit, as manufacturing cuts back, as the cost of capital rises, again, all of these items are putting a significant pressure, in my view, on GDP as well as earnings for the S&P 500. Again, here's another, byproduct of that, where housing prices remain under pressure. This is the median sales price of new homes sold, year-over-year percent change in decline. That makes a lot of sense as the mortgage rates have soared. Real retail sales are down, but again, this I apologize for actually not updating this chart. This is actually now back up to positive territory here, but again, it's been kind of a roller coaster, up and down, but it's been negative for 7 consecutive months. So the vast majority of 2023, we've been in decline year over year. It just popped back up positive as of September, and we'll see what October has in store. And all this is happening while unemployment is still low. So this is why I believe that the Fed is unafraid to keep policy tight. They believe they have a lot of leeway with taking unemployment back to 5%. That would still be considered a full employment economy. So they want to keep conditions tight, even if it means unemployment goes to 5%. If that means that inflation gets back under control. But I'll tell you right now, in past, lives, 5% unemployment was considered to be completely fine. But if this number gets to 5%, that's going to be a substantial hit to earnings, because you typically don't see job cuts unless if demand is cratering. And again, job cuts are a reactionary, that's a reactionary sort of development. When companies start to see declining revenue, when companies start to see other factors such as margin pressures starting to build, when companies see negative operating leverage because of that, they react by cutting jobs. So even though job cuts lead to sort of an increase in earnings, because it's acting in reaction to declining revenue, it typically is never enough to combat the full extent of revenue pressure. So even as companies increase, cut jobs, as we saw during each of these past recessions, that's typically never enough to buoy earnings per share. So, if we get from a 3.7% unemployment rate to a 5% unemployment rate, I believe that's going to be, coincided with a substantial hit to earnings. And I believe the Fed is not afraid of doing that because their goal is singular in mind, which is to have a 2% inflation economy, even if it means a mild recession. Cyclical job growth has flipped negative now year over year for 4 consecutive months. This is the other part of the equation where we're looking at jobs. Cyclical employment measures the labor force working in sectors outside of government, education, and healthcare. So we have to make this distinction for analytical purposes because we want to know where the job gains are coming from. So because government, education, and healthcare, they don't really go up and down with the business cycle. So they can distort the headline number. So we should remove those to understand where the true underlying private cyclical economy is doing with regards to jobs. So now that that number has been in decline for 4 consecutive months, this is a leading indicator for the aggregate employment figure. So if this continues for another couple of months, I think it might take about 6 or 7 months before the headline number comes down. But now we're at month number 4. Now we will see what happens when we get the jobs report tomorrow for the month of October, what happens there. But if that's month number 5, and then if we get month number 6, you're going to start to see the headline NFP number go negative year over year. So this is the leading indicator for headline non-farm payrolls. At the same time, BLS has revised the headline NFP number every single month through August by a total of 16% year to date. So that's quite substantial. Again, what does all this imply for stocks? We're still at high PE multiples relative to where we are in the interest rate environment. The last time we had 5% interest rates, we were at PE multiples well below where we are today. And also, we were at growth rates higher than where we are today. We're looking at basically flat growth this year. No growth for 2023. In fact, slightly negative for 2023. So the last time we had 5% interest rates, we had higher growth expectations and a lower PE than where we are today. So it makes no sense for stocks to be at, an 18 PE multiple as we are right now. I believe that the correct number should be at 15, maybe 16 times on lower earnings expectations. So if we actually did that, that would imply, a 20% decline from today's levels. At the same time, you can see the 1-year Treasury yield comfortably surpasses the free cash flow yield for the S&P, again, by the largest margin since 2007. This is, again, at the margin, without growth, it makes no sense to be owning stocks over short-term T-bills. Right now, it pays to own short-term T-bills and not take risk, especially in a market where in a market where there isn't a whole lot of growth outside of a few certain companies. At the aggregate, S&P 500 is not growing this year. It's expected to grow next year. But again, because of all of these factors that I mentioned, I believe that those earnings growth expectations are under severe scrutiny. I think that's going to start to happen in the next couple of months here. Here you can see a couple of anecdotes from the ISM Manufacturing survey. There are concerns relative to the slowing economy. You can see that FedEx has, issued a couple of warnings, where the CEO has said that we are in an environment marked by demand challenges. They have made adjustments to that by grounding 29 aircraft in this year. Maersk, which is the largest shipping company in the world, they're flat out saying that they expect a recession in North America and Europe in 2024. Here's another metric. This is from American Express company filings, and you can see that their bad debt provisions. This is a contra account that they log on the income statement. It works against them on earnings. These bad debt provisions are actually at pretty much the highest levels since the last time we had a recession, which was during COVID, and prior to that during 2007, 2008. And you can see that number has been rising. It was at 400 million in Q2 of last year. That's now tripled to 1.23 billion as of Q3 this year. And so these levels are consistent with recession. And remember, AXP doesn't have a whole lot of credit risk. They're not a lender to people with low credit, scores. So for them to start showing this actually means something. So that's another data metric to take into account. And here we have a discounted earnings model, which again confirms my basic PE multiple and earnings expectation for next year approach to valuing the market. I think that there is substantial declines in the S&P coming in the next couple of months, perhaps over the next 6 months. I believe that the downside targets are substantial by 20% or more. Shiller PE, again, that also suggests, lackluster returns over the next 5 years. So again, my primary conclusions are that the direction of leading fundamental indicators, including the rising cost of capital, primarily the rising cost of capital, that's driving, most of the weakness that we see here. At the margin implies negative pressure to S&P earnings. This means that analysts will mark down both this year and next year earnings forecasts. At the same time, markets are priced for earnings growth at the current forward PE of 18 to 20 times. I believe it's currently at 18 times. If that doesn't happen, then there will be a substantial drawdown. And I believe that this downturn has already begun. As we can see with the chart of the stock market, we hit highs in the summer and we've been in higher highs and higher lows ever since. We're seeing a little bit of a bounce back in the market today. But I believe that this is a lower high followed by lower lows. That's my opinion. But these three things together tells you that I believe that there is substantial downside to come in the S&P 500. So again, my capital allocation for 2023 and 2024 is stay defensive. Be in 1-year Treasury yields, which currently pays, they're basically begging you to not take risk, right? You can be parked in 1-year Treasuries that pay you 5%. You can also buy a money market mutual fund. I recommend only holding money market mutual funds that own treasuries and or deposits funds directly with the Fed, namely the Vanguard Treasury Money Market Fund or the Fidelity Treasury Money Market Fund. Look for money market funds that use that word treasury in the name. That tells you, exactly where they're parking that cash. You can also supplement that with the Zacks earnings certain portfolio. Specifically, look for companies that have low beta, are showing strong dividend growth and or share buybacks, and low Shiller PE. That's the key here. You don't want to overpay for these companies. So position for a low growth environment with a combination of recession-resistant growth and income. These are the types of companies that we own in the earnings certain proxy portfolio. So I hope you have, again, found this helpful. Again, any questions, any feedback, if I'm wrong on any of this stuff, please do reach out to us. I'd love to hear your critical feedback. So please, again, reach out to us at any time with questions and feedback. I'd love to hear from you guys on that. Take care, everyone, and hope to see you again on the next several webinars. Bye-bye.